Hello. Thank you for joining us for part 2 of this special training series collaboration between the National Good Food Network and Farm Credit. My name is Jeff Farbman from the Wallace Center at Winrock International. This special series is designed for food hubs and related businesses to take control of their finances using accurate industry standard practices. Once these skills are put into practice, operators are able to make better informed and therefore smarter operational decisions. This is the second part of the 5-part series. Today, our presenters, Erin Pirro and Gary Madison, will turn their sights on exploring the balance sheet, one of 3 main reports for financial management. I want to remind you that on Thursday, in other words, in 2 days, there will be a full hour with Gary and Erin to directly answer your specific questions. We're framing this as an office hour section. There will be little to no formal presentation during that time. It is really meant to make sure you fully understand all concepts and implementation details so that after this series, you will be ready to manage your hub using these critical financial reports. So today and tomorrow, please think about and start to try to implement the ideas in this webinar, and bring your questions on Thursday. Our next lecture class is next week on Tuesday, and again, office hours will follow that on Thursday. Today, I'm going to let Erin and Gary jump right in without an introduction, but I did want to give you a reminder that we are recording these webinars, and you'll find a link to the recordings once they're posted. Usually, I'm going to try to post this one tomorrow on ngfn.org/hubfinances up there at the top of your screen. Also, there's going to be a bit of a question and answer time here. Just for reminder, over in the control panel, there is a questions box, and you are muted, so you can use that questions box to type your questions for our presenters. Anything that we don't get to today, we will save for Thursday. And again, webinar archived, ngfn.org/hubfinances. So Gary, Erin, jump right in.
All right, good morning, or good afternoon now. Thank you, Jeff. Today we're going to talk about the balance sheet, and as some people say, the dreaded balance sheet, but there's really no reason to be scared of it. Think of it as a picture of your business, a snapshot in time, and what it's doing is it's capturing the assets as well as the liabilities and equity of your business. So it's looking at the financial position. The assets are how much you own, and the liabilities are how much you owe. The difference is the equity, or the amount of the business that you own outright and control. The more leverage you take on, meaning the more liabilities you have, the less decisions you get to make, or the less requirements, or the more requirements you will have that other stakeholders have placed on the operations of the business. So the less freedom you have, so to speak. Now, there are 2 types of balance sheets. That's the book value that your accountant will work with that records the actual cash transactions or accounting numbers that happen. For instance, I pay $20,000 for a vehicle. I've depreciated $5,000 of it. Now I have a $15,000 vehicle left on the books. However, a market value balance sheet is going to look specifically at what that asset is worth today. That may be $15,000, but it may be $12,000 because I've put a lot of miles on it. Or it may be worth $18,000 because I took very good care of it. You never know, and that's why it's important to look at the market value, not just at the book value, to get a true picture of where your business stands.
So when you organize your assets and liabilities on a balance sheet, you get to see how much equity or ownership you have in the business. The more equity that you have, the more the business of your own business you own. And ownership is different than control. You can control assets even if you have borrowed the money to buy those assets. Your balance sheet shows what you control and how much of it you own. So when you borrow money to buy a warehouse, you legally own the warehouse and you control it. The warehouse appears on your balance sheet as an asset, as does the liability of the mortgage loan that you took out to pay for that asset.
Now, see how much this green box represents of the entire asset base? It's about 1/4 of it. So that's a smaller equity position as related to the overall asset base of the company. Now, as we earn money, pay down debt, acquire more assets, we build equity, which means if we were to look at that on the next slide, we'll see that the equity box has increased dramatically, which means now we have more control over a greater portion of our business. We've earned that, and that's something that we have that provides a cushion, and it can help us fall back on that cushion if we face a rainy day. Now, what's great about this balance sheet, and you've seen the difference between these two slides, is that it's a measure of progress. So that scorecard in the game of life, here's one for your business. And on a personal level, when my husband and I bought 45 acres a few years ago to start our farm, obviously we spent a lot of money and we borrowed a lot of money as we built a house and are starting on barns and fencing and so forth. And that can be pretty discouraging if you only look at what's in your checkbook. But we made a habit when we got married that we would, as part of our New Year's Eve date, do our balance sheet. So we write down everything that we own and everything that we owe, and we compare what's happened during the year to the previous year. So it's pretty fantastic to be able to see, oh look, we paid down the mortgage by this much. Hey, we've put some money in our savings account, maybe in our retirement funds. We've spent X number of dollars on fencing or on the driveway repairs or so forth. And we can actually see that financial progress. Now that works on a personal level as well as on a business level. And if you take the time to do it, you're going to be very glad that you did. It's also important because you can use that information to share with the key stakeholders in your business to show what you've earned and what you've accumulated. You know, you can show the board of directors, here's what's come of this year, and we want to target this equity to support one of our mission-related investment programs.
The next level of detail for your balance sheet is to put your assets and liabilities into categories based on a time factor, which you can think of as expected useful life. Current assets are defined as cash or things like receivables that can be converted into cash within a year and can be used up quickly. On the other end of the scale, fixed assets like real estate are much more difficult to convert into cash since it takes time to sell, to list the real estate, and also the useful life of that fixed asset like real estate is usually long term. So if your accounting system doesn't do intermediate term, just call it a long term or fixed asset and put it into that category. But the most important thing is to make the terms of the assets match the liabilities for those assets. An example is that the building you own is a long term or fixed asset, so the matching long-term liability is that mortgage loan, and they should balance each other both in the term or the time factor, as well as you can look at it as expected useful life. One of the cautions here is that if you buy an asset, let's say a truck, and you pay for it, you can only manage a certain low payment. So you say, I'm going to make these payments as low as I can. I'm going to finance the truck over 7 years, but the useful life of that truck is only 5 years. What you've done is create a real problem that your balance sheet will point out to you. You've taken what should be an intermediate asset and you've financed it for longer than the useful life of that asset, which is going to create a little bit of a problem in your balance sheet by having something that may be looked at as an intermediate asset become really a long-term liability because you're paying for it over too long of a period of time.
Right, and there's nothing more depressing than trying to sell it and figuring out that you still owe more than it's worth. All right, so moving on, we're going to take a look at an actual balance sheet. We talked about assets equaling liabilities and net worth, so here's what it looks like on the full scale. Now you'll notice a couple of things about this balance sheet. First, it is allocated as Gary just described, current assets on top compared to current liabilities. Then we've got intermediate assets and liabilities, and fixed assets to go with fixed liabilities, or long-term as the other case may be. Now you'll also notice that it's a comparison. So we're looking at the end of 2015 and comparing to the end of 2016 so we can see what kind of progress has been made. Our current assets, or as Gary said, those things that will be turned into cash in the next year or already are cash, right, as part of normal operations. And it's going to help us look at and compare to current liabilities. Now you see current portion of intermediate and long-term loans have been included in current liabilities because that's the portion that you are expected to pay within the coming year. And that's a really good thing to know sitting on January 1st because you can make a plan for the year. Now this balance sheet tells you a whole lot of stories about your business. The first of which is, what is your net worth? That's another word for equity. And by calculating your equity, not just in dollars, but also as a percent of total assets, helps you see where your business is positioned and helps you make the right move for the next decision. So let's calculate our net worth, which is simply owner's equity divided by total assets. Right? The equivalent math is owner's equity divided by the total of liabilities and owner's equity. Same math. But if I do this for 2015 year end, I see 194,500 divided by 1,024,500, and I see that net worth is 19%. Is that good or is that bad? Well, we need to compare that against some industry standards, against our past history, and against our goals to figure out. And that's where a benchmarking tool can be very useful. So to internally benchmark or look at our progress, we do the same thing for 2016 and take $438,550 of equity at the end of 2016 and divide it by our total assets at that point of $1,160,308 and get a 38% net worth. That's a big jump, and it's headed in the right direction. So if we're going to look at what percent net worth is and how does it compare against the industry or what we need to do next in our business, Dr. Dave Cole of Virginia Tech came up with these great traffic light barometers. Right? Think about what a traffic light tells you or should be telling you. If you've got a red, that means stop. A yellow means proceed with caution. Notice I say not what it really means in traffic, but what is it supposed to mean. And then green means go. So take your net worth, as you've calculated percent equity, and compare it to these standards. So for our example here, our net worth at the end of 2016 was 38% equity. Now if we were to look at this chart, it's giving us a red because it's less than 40%. So what does that mean? We really need to stop and consider our financial position before we go make our next investment. You see, when the farm next door comes up for sale or the warehouse next door in an ideal location comes up, we're going to move heaven and earth to make it happen. But that is going to create a lot of stress down the road if we're going to borrow our last dollar. And all the red is an indication that we're not financially ready to take that next move. If we find we're in the yellow, it's not a stop, right? But it's a proceed with caution. Think about what we're doing and make sure it makes absolute financial sense and that we have plan B, C, D, and probably E if things don't go as expected. Right? We're sitting up here in the Northeast where when you borrow your last dollar to buy the dream house is when you find out that the furnace breaks and you don't have any money to pay for a repair, let alone the replacement. And that's the position you can find yourself in when you don't plan. And just running these numbers and looking at that story can make a huge difference, not only for your checkbook, but for your stress level down the road. The goal is to get to green so that when you are at a place that you absolutely want to take advantage of an opportunity, you can do so.
You should get used to the idea of using your balance sheet to think about your next move. Like Aaron said, strategically, should you rent or lease? How much do you really need that truck? Would you really consider buying a delivery truck that you're only going to use for one day a week versus renting that on a daily basis from U-Haul? It may be more effective in the long term to buy that truck, but your balance sheet can tell you if you can afford it now.
Another great thing the balance sheet can tell you a story about and help you plan for is your liquidity position. We measure liquidity in two different ways. The current ratio is a division of current assets by current liabilities, and the working capital is a magnitude measure, so current assets minus current liabilities. And what these two ratios do is tell us or signal to us how are we positioned for the coming year as we look at the things that we're going to need to pay. So if I look back to this balance sheet example and we only look at the current assets and current liabilities, we've color-coded them to make them easier to do the math. But at the end of 2015, if we look at the current ratio, we'll divide 224,500 by 220,000 and get a current ratio of 1.02 to 1. That means I've got $1.02 on hand to cover every dollar of liabilities that I expect I'm going to need to pay in the coming year. And that's why it's so important to keep that current portion of loans included, because I know I'm going to have to pay them. And if I just left them out because I didn't want to go through the exercise, I might be in for a nasty surprise. Now, I don't know about you, but in my neck of the woods, is having $1.02 on hand to cover $1 going to be adequate? What happens to costs in your neck of the woods during the course of the year, Gary?
They always go up around here. And there was also the unforeseen expenses that you have to wiggle into your current ratio also.
Right. So that old wisdom, right, the conventional wisdom of having a 1-to-1 current ratio may not be enough. And a lot of that's going to depend on what's your risk tolerance, what's your wherewithal. So if we look at the same ratio then at the end of 2016, obviously our company has earned quite a bit of money because we now have a current ratio of 2.09 to 1. So we're better positioned to handle not only what we know is coming, but we've got a cushion for what we don't know about. Now, a current ratio of 2.09 to 1 is well and good, but we need to think about the magnitude, because I could be sitting here with $2 and owe Gary 1, which means I've got a current ratio of 2 to 1, but my working capital of current assets minus current liabilities is only $1. And that's not going to get me very far. You can see that in the 2015 working capital position, where when we subtract 224,500, right, start there and then take out the $220,000, we've only got $4,500 of working capital, which you'll notice isn't even enough to pay the loan, never mind the things that we don't know about. So in 2016, that working capital position improves to $193,550, which is a whole lot more of a cushion and a position I'd feel a whole lot better about being in. Now, how much working capital do you need to have? A lot of it's going to depend on what kind of products and services you offer and how often income is received. Because if you have a very seasonal crop or product, you're going to need a lot more working capital to pay the bills throughout the rest of the year, right? Eggnog is a perfect example. Any of my dairy producers that work with eggnog only get money for that at a particular time of year. Right? Compare that to a value-added product that's always in season, such as the tomato sauces. You know you can sell those year-round. You also need to consider when and how often you're expected to be paying your vendors and how stable those prices are. The more instability and the more fluctuations, obviously, the more working capital you need on hand. And you need to be positioned for surprises. None of us like them, but they do happen. And the better able we are to work up our working capital, the better we're going to be able to deal with surprises. So a good guideline is to think about having a quarter of your business expenses covered by your working capital position. And if you think about that in the personal finance realm, most of the experts point you towards having a 3-month supply of cash on hand to cover expenses in the event that you lose a job or are hurt and can't work. And look at that. 3 months works out to be 1/4 of a year, or 25% of your yearly expenses.
And Aaron, this concept that we're looking at here of using the balance sheet to determine working capital dollar amount is something that we're going to cover in another webinar, which is cash flow budgeting. So your balance sheet can tell you how much you need over the course of a year, but to know when exactly you need that money is a cash flow budget sort of question. So
Indeed.
about this whole thing of the balance sheet and how you use your balance sheet, it's probably best to think of it as you being the primary audience for your balance sheet. You have to understand this because it's going to be on your head if your Food Hub business fails or underperforms. So you have to know for whom you're preparing this document and how do you expect them to use it. We've given you some examples along the way here in this webinar on how to use it. But here's the kicker. Even if you yourself aren't preparing this balance sheet, let's say you have a bookkeeper who does this for you, as a manager, you need to be able to understand your balance sheet well enough to describe to others the current state of your operations assets and how best to deploy those assets in the future. That comes down to being able to explain to your board of directors, you know, we're going to have to rent a truck for another year because we don't have enough strength in our balance sheet to reasonably be able to afford an obligation for as long as it would take to pay off a truck. It's all too easy as a manager to think about your balance sheet as a piece of history instead of being a starting point from which you're going to plan what to do next. Okay, so I don't know how many of you were in FFA, but the motto of FFA is learning to do, doing to learn. That means basically, you know, if you try something out, you're going to learn it a lot better than if you just, for instance, listen to a subject topic on a webinar. So
right, roll up your
Aaron
sleeves and get your hands dirty.
that thing, exactly. Even if it's only pencil dust, it still counts as getting your hands dirty. So Aaron and I have decided that all of you participating live in this webinar would benefit from a little homework. We want you to prepare a market value balance sheet and then use it to calculate your business's net worth, your business's percent net worth, the current ratio, and your working capital using the formulas on this page. And if you don't have those figures for the Food Hub that you work for, you can go ahead and do this with your own personal information. And you can then compare your percent net worth to the traffic light standards on slide 11 to see how you're doing. Okay, so that's the homework. To offer a carrot to go with this stick we've been beating you with, we are offering prizes. Here's how it's going to work. Calculate for your Food Hub or for yourself the items on this page: net worth, percent net worth, current ratio, working capital, and the traffic signal, and email those results to me by 8 a.m. Thursday morning, March 2nd, at the address that's going to appear on your screen during the Q&A portion of the webinar for me. From among all the complete entries, we're going to randomly select 3 winners who will receive a farm animal USB drive and a farm credit hat. Aaron, can you show us these terrific prizes?
I don't know, did I get a picture of them? I think even more importantly, though, you're saying, how and when can I do this? Well, we've got this common chart of accounts as a starting place for you. So here's the balance sheet portion, and Jeff is going to post these on the website as well. But take a look at these. On the asset side of things, you'll notice the broad categories in which you're going to place your assets, right? Starting with current assets, cash, accounts receivable, inventory. And you'll notice that some of these are broken up into smaller subcategories. Do that wherever it makes sense for you, because you want to make sure that this is a management report you can look at on one page. You're not trying to bury anyone in details. If you have questions, you should be able to drill down into a particular category. And that's the idea behind that inventory. A lot of these are categories within the business, different product lines or different departments. And if you have a good handle on what those are, you're going to have a lot better time as we go through the rest of the reports, knowing what makes you money and how much it costs you in order to make that money. A big piece of that is going to be knowing what's on hand at any time, because although we don't like to deal with it, we know there is shrink, and we need to account for that along the way. The intermediate and fixed assets are broken down into categories where things are grouped together. And if you want more detail than that, by all means, you're welcome to. But remember, you're trying to balance management information with what you need to know right now. I have seen accountants or customers that want to put a different asset account for each piece of equipment they own, but that doesn't really get you anywhere on a day-to-day basis. Right? You really need to know the totals, which are way more important. Also, if there's something very unique to your business that you want to separate out so you can keep an eye on it, you're welcome to do that too. Right? It's all about getting you the most useful management information right here, right now.
So looking at the current liabilities side of this balance sheet, first there's accounts payable, which are just things we brought on credit. Accrued expenses are things you know that you owe, but you haven't been billed for yet. For example, your payroll may happen in 2 weeks, or your property taxes may be due in 6 months, but what is that worth now? And that's a higher level of accounting. Under intermediate liabilities, containing the loans or a capital lease, each of these loans or leases should be separate so you can track the pay downs and the draws from those leases. But I think one of the most important things to put a little detail onto how you keep your balance sheet clean, as Aaron suggested, don't keep creating subcategories. Rather, get into the habit of entering bills into your accounting system, like QuickBooks, for instance, right when you receive them, even if you don't pay them. Keeping a pile of bills on your desk may be your current filing system, but if you enter the bills right away, you can keep track of them. You can print lists of those bills. You can go to others in your organization to assess which bills you should pay first and figure out if that leaves you enough to cover payroll. The goal is certainly to avoid surprises. And then when you want to actually pay the bills in QuickBooks, you just click a box that says pay this bill. So entering bills into your accounting system allows you to see the detail in your balance sheet without inventing a new subcategory. From a management perspective, if you're not doing this and you're filling your time with other things, then you should examine your priorities. Wasting time or doing the things you like to do is something that you should recognize your behavior as a contributor to achieving your management goals. In the end, you need timely and accurate records to give you a greater chance of informed decisions that are going to lead to success.
Amen. All right. Jeff, do we have some questions?
One so far, which I will ask now. In startups, there are often loans from family and friends and fools that exceed assets. Can you have negative equity?
Oh, great question. Absolutely, you can. Right? Think about a college student. When I graduate with that sheepskin, that's going to help me make a whole lot of money in the world. I don't really have any street value for that. I can't sell it to somebody else, but I have a whole lot of student loans to go along with it. So it is very possible and very likely that in that stage of life, I would have a negative net worth. So it's important to track all of those things so you can set the appropriate goals and look at the progress you're making. Right? Because for some of us, it may be achieving 50% net worth, but if I'm in a negative equity position, it may be just getting to zero. And that's a huge first step. And then I'm going to keep going from there.
Great. All right. If there's one more question, maybe we can get it in. But we are heading to the bottom of the hour. So why don't I give a huge thank you to Aaron and Gary for another excellent webinar. I'm going to show you the full schedule of the webinar series. Now you see we've done the introduction, and the balance sheet was today. In 2 days, on Thursday, please join us for this office hour session, and then again the following Tuesday for the next lecture, which is on the profit and loss statement. Brevity is the soul of wit, so I will close only with this. You can find the National Good Food Network on YouTube, on Twitter, and on Facebook, as well as our website, ngfn.org. Contact us at any time. Our email address is contact@ngfn.org. And please fill out the post-webinar survey. It will open in your web browser in just a moment. It really helps us to improve the series and our webinars in general. And then go make and study your balance sheet and bring your questions on Thursday. All right. Until then, thank you very much. This ends the webinar.